Many thanks for staying with us. Welcome to Business Incorporated on Channels Television. I am BC Adebayo. On today's program, British Petroleum's chief executive Bob Dudley stepping down next year after 40 years. And Egypt's petroleum ministry says the country lowered domestic fuel prices as it begins linking energy prices to international markets. Plus, Kenya's first green bond raises 4.3 billion shillings and rated B1 Global. But let's get the show started now with the markets and investors' sentiments here in Africa, where it makes that intraday. The NSE here in Nigeria was down 0.07%, while the JSE gained 0.31%. Egypt closed for the week on Thursday negative 1.14%, and Kenya was positive also on Thursday. And markets in the Middle East ended the week mostly negative on Thursday, with Saudi Arabia's index losing 0.79%, with Al Rajhi Bank down 1.1% and Sahara International Petrochemical plunging 5% as the stock traded ex-dividend. In Qatar, the main share index ended 0.47% lower, and that was driven down by a 1.4% fall in Qatar Islamic Bank and a 0.6% slip in Qatar National Bank. In Abu Dhabi, the index slipped 0.06%, extending losses for a full straight session as market heavyweight First Abu Dhabi Bank dropped 0.7%. However, the index in Dubai rose 0.61%, led by real estate stocks. Well, let's see what's making headlines in the UK markets today, where British Petroleum's chief executive Bob Dudley is stepping down next year after running the oil company during one of the most turbulent periods in its history. Let's talk to Juliana Olayinka, who's standing by from our London studio for more. It's good to see you again, Juliana. How are you doing today?
I'm great, Bissy. Nice to see you.
Nice to see you too. Now, the UK's global oil giant BP today announced its CEO Bob Dudley is stepping down, who will be stepping into his 40-year-old shoes at BP. And how's the stock market treating this piece of leadership change?
Well, as soon as this was announced this morning, BP shares were actually up 0.06%, although Dudley's resignation comes amidst three big resignations for FTSE CEOs this week. Of course, Dudley's being the biggest. After 40 years, he has stepped aside and he'll be taken over by Bernard Looney. Bernard Looney runs the upstream market for BP, and he'll be taking over in February next year. There doesn't seem to be anything shady to Dudley's departure. He did say that he wants to retire around his 65th birthday, and he is 64 at the moment. There's been heaps of praise, particularly from other chief execs at BP. He took over Dudley in 2010. This was at a time where BP were in serious trouble, considering there was that Deepwater Horizon. There was a huge Gulf spill, the biggest oil spill in America's history, and 11 oil rig workers were killed at the time. And since he's taken over, BP shares have risen 23%. So, you know, it's a big loss for BP, but it does come at a crucial time since the Paris Agreement was signed and countries have said that they will do their best to tackle global warming. Oil giants like BP and Shell and the rest of them are under increasing pressure. So he is going to be handing over the baton to Looney at a time where it's difficult, but it's a big loss for BP, I must say, Bissy.
Well, absolutely. Now, a new report shows that the UK's new car market was down 2.5% in the first 9 months of 2019. Juliana, are you one of those postponing buying that new car in the UK?
Well, in short, I would say yes, Bissy, I am. And it doesn't seem like I'm the only one. Of course, there's been a spate of bad data in recent weeks from the UK. And according to figures from the Society of Motor Manufacturers and Traders, demand for new cars in Britain is sluggish. Again, from the organisation, it really is a kind of copy and paste, as you've heard from anybody who's suffering losses at the moment in Britain. And they're blaming Brexit. They're saying Brexit uncertainty is stopping people who would usually upgrade their cards from doing so. One of the most important factors of this data is just the comparison to what's happening in Europe, on the continent. Now, in the UK this month, we saw a rise of 1.7%. But in places like France, Germany, Spain and Italy, their increases are all double-digit figures. So it seems as if people in the UK are concerned about Brexit, but on the continent, it's contrary to that, and they're spending money.
All right, Juliana, it's been a very big week on politics and Brexit. So what's the state of stocks and currencies today as we head for the weekend?
Well, surprisingly, there is a sigh of relief on the FTSE this morning. It started in the blue, but it's risen slightly at intraday. Let's look specifically at those figures, Bissy. The FTSE All-Share is up 0.17%. The FTSE 100 also up 0.23%. The FTSE 250 intraday slightly down at 0.06%. In currencies, the British pound is down on the US dollar by 0.09%, down on the euro by 0.26%, and down on the Japanese yen by 0.24%. Thank God it's Friday, Bissy.
Many thanks, Juliana. Thank God it's Friday. We'll see you again next week.
Thank you.
And stocks in Asia fell more than 1% today following more than 4 months of pro-democracy anti-government protests. In Japan, the Nikkei recovered from an earlier slip to close 0.32%, while the Topix index finished its trading day 0.26% higher. In Australia, the ASX 200 rose 0.37%, and that's as the Hang Seng index dropped 1.11% at the final hour of its trading. Markets in China were closed today for a holiday. And in the U.S., stock index futures showed a slightly lower open on Wall Street ahead of the key monthly jobs report. Dow futures indicated a drop of more than 80 points at the open, while S&P 500 and Nasdaq futures also traded slightly lower. Markets on Wall Street closed higher following a 2-day intense sell-off as there are growing expectations that the Federal Reserve will cut rates later this month. Well, back here in Africa, in Egypt, where the Petroleum Ministry says the country lowered domestic fuel prices as it begins linking energy prices to international markets, and that's part of an International Monetary Fund-backed pricing mechanism. The price of 95-octane fuel was lowered to 8.75 Egyptian pounds a litre from 9 Egyptian pounds. 92-octane was cut to 7.75 Egyptian pounds a litre from Egyptian pounds, and 80-octane was reduced to 6.5 Egyptian pounds a litre. Well, the price of fuel for industrial use was set at 4,250 Egyptian pounds per tonne, down 250 Egyptian pounds, while the domestic price of gas for the cement industry was set at $6 per million BTU from $8, and at $5.50 per million BTU for metals and ceramics sector from $7. The government raised domestic fuel prices 4 times since it agreed to a 3-year economic reform program with the IMF in November 2016, bringing most energy prices up to international levels. Well, we're still in Egypt, and this time the central bank governor says the government is discussing possible further assistance from the International Monetary Fund to help it carry out structural reforms once its current 3-year IMF program ends next month. It says the country has done fiscal and monetary reforms, but now aims to do structural reforms. Egypt signed a 3-year $12 billion extended fund facility on November 11, 2016, after allowing its currency to weaken sharply, implementing a value-added tax and raising fuel prices to reduce its balance of payments budget and deficits. Turn now to Kenya, where the first grain bond has raised 4.3 billion shillings, priced at an interest rate of 12.25% and rated B1 Global to build environmentally friendly student accommodation. Stanbic Bank, which arranged the deal, say the subscription book was well diversified with significant interest from Kenyan domestic pension funds, commercial banks, insurance and reinsurance companies and non-resident funds. The issue, which was looking to raise a minimum of 2 billion shillings and a maximum of 5 billion shillings, will help protect Kenya from the impact of extreme weather in the agriculture sector, which contributes about 1/3 of annual GDP. Well, let's fly away to Europe, where the stocks traded mixed early today as investors keep their eyes on U.S. jobs report that could help determine monetary policy in the world's largest economy, as well as growing trade tension between the U.S. and Europe. Well, Chelsea Delaney is waiting to tell us more. She joins us live from the Frankfurt Stock Exchange. Chelsea, let's get right into it. Now, let's take a look at the U.S., where the markets have been struck by volatility this week. Manufacturing and service sector reports. We've just received the U.S. jobs data, so tell us what's in it.
So the jobs report came in basically mixed. The headline number was 136,000 jobs were added in September. That's a little bit below what economists had been expecting. They were expecting something around 145,000, 146,000. So a little bit lower, but at the same time, a solid number. The estimates are that, the U.S. needs to be adding 100,000 jobs a month to really be in a solid labor market. So pretty solid there. The other surprise here was the decline in the unemployment rate. It fell to 3.5%, which is the lowest level in 50 years. So that's another positive sign. So we're seeing in the markets, it's pretty early. The numbers have just come out, so we'll have to see how sort of it progresses throughout the day. But we did see a rise in stock futures. The S&P futures were up about 0.1%. They'd been down before the report. And we're also seeing a rise in European stocks. So the DAX is spiking, the Euro stocks is up as well. So investors are sort of taking this as, a solid report, and you have to consider just how much angst there was coming into this report. As you said, we had seen a lot of really bad data, a lot of bad manufacturing data, but also service sector data ahead of this. So for now, this sort of puts to rest a little bit of the fears that the U.S. economy is really like falling off a cliff here. So this will definitely do a little to underpin the market going forward.
All right, Chelsea, I see you in the studio. They actually thought you were at the exchange. Well, let's move on now. The German foreign minister has said he expects the European Union to hit back against new tariffs announced by the U.S. this week. How is the threat of more trade tension between the U.S. and Europe impacting the markets?
The reaction markets has actually been pretty interesting so far. This report came out yesterday, and we saw actually the stocks that would be impacted by the U.S.'s tariffs rise, which is a little counterintuitive. But what we're hearing from investors is that people had been expecting a more severe tariff situation from the U.S. So the level of tariffs, the number of products that are being hit here, people had expected more. And now the question is really going to be, what does the EU do? There seems to be some division between EU officials. As you mentioned, you have the German foreign minister saying we're going to hit back, but you also have some officials in Brussels saying we need to take a more considerate approach here, and we need to strike a deal because there's a lot of headwinds right now for the European economy, and can they really handle more of a trade war with the United States? So right now, investors are sort of taking a wait and see approach to this threat of trade tensions, but there are a lot of important dates coming up. Next month, the U.S. will decide on another round of tariffs that could impact a much broader swath of European products, $100 billion worth of car imports. So I think people are going to wait and see sort of how the U.S. approaches that as well.
All right, Chelsea, just before I let you go, quickly, tensions are rising also in Hong Kong as the city's leader announces a ban on wearing face masks at public gatherings as protests continue. Is a clash between protesters and the government spooking investors?
Unfortunately, yeah, I don't think it is. I think the takeaway from this is that we are really seeing an escalation in the tensions. The Hong Kong executive has banned face masks, which has sort of irritated protesters more, and so we're actually seeing protesters out today protesting more. And the fear is really that this escalates into more violence, and that could really have a broader impact on not only the Hong Kong economy, but also the China economy, because you you have to consider what an important conduit Hong Kong is for investment and business in China. So we saw a sell-off in the Hong Kong stock market today. It closed down about 1.1%. But I think, unfortunately, people are really seeing this as just the beginning of an escalation and these tensions between the protesters and the Hong Kong government.
Thank you, Chelsea, for those updates, and do have yourself a great weekend.
Thank you.
Business Incorporated returns in just a moment. Please stay with us.